So guys, this is a very strong stock right here. Welcome back in YouTube. Today we're going to talk about Medtronic. Now, I can't take credit for stumbling on this stock. We're going to give credit to Ari, Blue Lion Finance. This was definitely a recommendation that was shouted out. He is a dividend investor. I'll leave his channel linked below. When we talk about buying companies on the dip, I think these are the type of companies you really want to take a look at. Strong fundamentals and bright futures. By the way, if you are new to the channel, welcome in, consider subscribing, smash that thumbs up. We're talking about Medtronic today, and ticker symbol MDT. Medtronic is an American medical device company. Break down the fundamentals of this company, as this company has sold off, but yet the fundamentals are still strong in this one, so let's dive in. First, guys, I want you to understand that this is a dividend company. Now, a dividend is a way for companies to return capital back to the investor. Whether it's buybacks or whether it's dividends, it's always nice to get a return back as an investor from companies that have strong fundamentals. It has raised its dividend every year for the last 43 years. Very, very impressive. You have to have extremely strong fundamentals to keep up this kind of pace when we talk about dividend stocks. One thing is about the company, dividend payout ratio is fairly high, just something to keep an eye on. I wouldn't be concerned about that right now, but I would keep an eye on this going forward. Doing $17 billion in 2013 all the way to almost $32 billion in 2021. Just good strong line top, just good growth on top line revenue. Overall, the company seems to be undervalued with a buy rating and a 33% upside. When we look at forecasts, everything from $101 all the way up to $149 we're gonna decide ourselves if this is an undervalued company and possibly a second look for a buy. So with a mature company like this, you're not gonna see astronomical revenue growth here, guys. We're looking like pretty mild revenue growth from one analyst expectation. Now, I try to average it out. As we can see here, this is stockanalysis.com. They forecast them doing about 2% revenue growth, 5%, 4%, 4%, 5%. But when we go to Yahoo Finance, oddly enough, Yahoo Finance has them overvalued by 13%, with next 5 years revenue growth at 12.66%. A big disparity with analyst expectation. This is why it's good to kind of do your own due diligence here, guys. You know, we're seeing everything from 4 to 5% on one analyst side and all the way up to 12%. Pushing 13% on Yahoo side. As we can see here, past growth has been right around 6.5%. So I'm going to be extremely conservative and use roughly 4 to 5% revenue growth. Profitability, very strong margins with this company. Very, very strong margins. Margins are outpacing sector median once again. So everything I'm seeing about this company, I'm really, really liking from the dividend side, from the margin side. They do have a decent amount of debt, which is probably a normal thing you're going to come across when we talk about medical devices here. But common stock, guys, they're not diluting you. They're actually taking shares off the market. So growing their assets here, going from $9.8 billion to $10.5 billion in cash and cash equivalent. Because they pay such a strong dividend and they've been growing their dividend, I would be willing to take less of a required rate of return personally of roughly 10%. Factoring in almost a 3% yield, that's 13% year-over-year compounding growth that I would be expecting. By 2030, to me, this stock could be a $145 to $150 stock, and you're buying it today. You're buying as many shares as you want today, under $90 a share. Seems to me like there's a tremendous amount of value. So guys, if I'm looking for an internal rate of return of 8% plus the 3% dividend, which would give me a compounded rate of return of roughly 11%, I have to be buying the stock probably right around $81 a share. Now, with that being said, there is some, with these quality companies, your companies like Coca-Cola, your companies like IBM, these companies that pay dividends, that have been paying dividends, and that have low beta, are trading at a premium right now. So therefore, it is definitely going to be, I don't think you're going to see that massive sell-off in this company. And when we factor in the pandemic low on this stock was $77.46. Today we're trading at we're trading right around $90 here. And we've hit a 52-week high, and a 52-week high of 134 I think you're trading in pretty value territory here while collecting a pretty strong dividend. Now, here's the caveat when we talk about valuations, guys. If they do have an opportunity to do over 5% revenue growth over the next few years, let's say it's high single-digit revenue growth. As we can see here, you're buying, basically it's a buy today, guys, and with a future valuation of price of 169. Okay, so you're basically doubling your money. If you think that this company can do high single digits for the next few years, you're basically doubling your money entering a position in this company by 2030 with dividends reinvested. So guys, I look at this as a very stable, steady growth. There could be a lot more upside to this company if we think that they do have an opportunity to do double-digit growth. But even if growth remains flat, definitely a lot of value in this company. So Ari, appreciate the shout out on this one. Very good quality company here. It's not a get rich quick type company, but if they can grow double digits, guys, there is a lot of upside to this company with not much downside at these levels. As always, guys, appreciate your time. Thank you so much for spending it with me, and we will see you next time, investors. Peace.